When the US sneezes, the world catches a cold. The world markets have been experiencing too many nail-biting moments in the last few days. And the fear is, what if the United States defaults on its debt payments and fails to raise its debt ceiling? First up, let us try to understand what exactly is the debt ceiling we're talking about. Now, the debt ceiling is the amount of money the United States government really is allowed to borrow to pay the nation's bills. Now, this issue of debt ceiling arises from the fact that the US has been running a fiscal deficit since the year 2001. Now, fiscal deficit is a situation when the government's expenditures are much more than its income. Now, since income of the US government is less than its expenditure, the government has to borrow to function on a day-to-day basis. But there is a limit to that borrowing, which is periodically increased to allow the government to borrow more so that it can continue to function and continue to work. Now, has the debt ceiling for US ever been raised before? Well, according to a report of the Council on Foreign Relations, or CFR, the debt ceiling has actually been raised 78 times since 1960, with the most recent one done in December of 2021, when it was raised to the current ceiling that stands at $31.4 trillion US dollars. Now, the US faces a deadline as soon as June 1st of 2023 to raise the country's borrowing limit, which now stands at $31 odd, to keep paying the nation's bills. Now, if this debt ceiling is not increased or suspended, the government will not be able to borrow and pay the outstanding dues or debt payments. Now, if the US defaults on its debt payments, it would be the first time when the nation would end up doing so. The US government has warned that a debt default could really cause significant disruptions to the financial markets and would further damage its own already slowing economy. An estimate by Moody's Analytics says that even if the debt limit were to be breached for no more than 1 week, the US economy would weaken so much, so fast, that roughly 1.5 million jobs would be wiped out. The US government's inability to pay all of its bills would then raise serious doubts about the nation's creditworthiness and sap the confidence of lenders, and also call into question the dollar's place as a reserve currency, the currency in which most of the international trade happens even these days. A loss of the confidence in the US dollar could also have a far-reaching economic and foreign policy ramification, as other countries, particularly China, would then default to push for their own currency to serve as the foundation of global trade. Now, if the debt crisis were eventually to send the United States crashing into a recession, America's economy would hardly sink alone. But can the debt ceiling crisis really affect the Indian economy? Yes, of course. The Indian market and the Indian economy can definitely face some sort of a downturn in case this happens, due to the centrality of the US economy to global growth. Now, with the United States economy shifting into reverse, many Indian businesses with exposure to the United States can face troubles in their operations, as investor sentiment could be hit and thousands could be laid off due to the crisis. If the US defaults, economies that lend to its market will definitely be impacted, as almost 30% of the US debt is held outside of its nation. India alone accounts for $220 billion US dollars of the total $31 trillion of the United States debt that it stands at currently. Also, there is a possibility of a massive volatility in the domestic currency markets as well. The equity markets may also come under huge stress, and in turn, higher interest rates could make more expensive for individuals and for businesses to then borrow money. Slowing economy and slowing growth could then push companies to slow down expansions, cut costs, and thereby slow down any kind of hiring processes and even cut jobs.
For more informative videos like this, keep watching India Today NewsMo.